Good evening, everyone. Am I audible? Can you guys give a yes in the chat box? Okay, perfect. Let us do one thing. Let us wait for 5 more minutes so that everyone can join in, and then we shall start with our session. Okay. Chalo, I guess we are good to go. So in today's session, we are going to cover some important topics about what do you mean by Macaulay duration? What do you mean by modified duration? What do you mean by convexity? What do you mean by effective duration, effective convexity? And what do you mean by key rate duration? Okay. Now, the whole thing is in a flow. Okay. You have to understand the whole thing is in a flow. I'm going to make it very, very, very easy for you. Let me just quickly share my screen with you guys. Just a moment. Okay. First and foremost, guys, let us understand how does a bond exactly look like? How does a bond look like? Let's just say Reliance is raising capital through bonds. Okay. Now it will mention the principal amount. It will mention the principal amount. Principal is, or you can call it as a face value, 1,000 million. Okay. It will mention the coupon rate, that is 10%. It will mention if it is an annual paying bond, semi-annual paying bond. Let's just assume annual paying bond. Annual bond. Okay. And this is an annual coupon rate. Or let me just mention it here. Annual bond. And it will mention the maturity. Maturity is 10 years. 10 years. Okay. And it will advertise this bond indenture. It will advertise this bond indenture. Okay. This is my bond. Please buy these bonds. It will advertise this bond indenture. Okay. Now, what do you think, guys? What do you think the price investors would be willing to pay for this bond? The price investors would be willing to pay for this bond, that will be dependent on the required rate of return, or we can call it as a yield to maturity. Is that clear, guys? Give me a yes or a no. Let me just write it down. Yes. Are we clear till now? The price investors will be paying for this bond will be dependent on the yield to maturity. It will be dependent on the yield to maturity. Now, in practical life, in real world, every year, yield to maturity keeps on changing. Every year, your yield to maturity will keep on changing. Okay. Let me just write this down. Yield to maturity will keep on changing. Investors' required rate of return keeps on changing. Okay, give me a quick answer, guys. Suppose you guys bought the bond when the YTM was 12%. Okay, you bought the bond when the YTM was 12%, and next year YTM increased to 14%. YTM increased to 14%. So will the price of the bond increase or decrease? Will the price of the bond increase or decrease quickly? Everyone is correct. The price of the bond will decrease. The price of the bond will decrease. Now, there is one more thing you need to understand about YTM. There is one important thing you need to understand about YTM. What does YTM exactly state? What does YTM exactly state? You can assume your YTM. Let me write it down. What does YTM exactly tell us? Okay, what does YTM exactly tell us? Okay, YTM actually gives us the rate that you will earn every year on an average basis. Okay, so so suppose you bought the bond, you bought this bond, suppose you bought the above bond, when YTM was 12%. So if you hold a bond till maturity, bond till maturity, you will make a return of 12% year on year on a compounding basis. Read this statement, guys. What does YTM tell us? YTM, it is the concept is similar to your CAGR concept, compounded annual growth rate. Okay, YTM tells us if you hold a bond till maturity, you will make a return of 12% year on year on a compounding basis. Is that clear with everyone? Is that clear with everyone? Give me a yes or a no. Yes or no, guys? Okay. Now let us okay, one more assumption. Now this one more assumption about this is, like, suppose this is your 10-year bond. This is your 10-year bond. Let me write this down. Today, okay, this is one, this is two. Similarly, this is 10. Okay. In the above case, our interest rate, that is the coupon rate, that was 1000 ka 10%, that is 100 million. 100 million. 100 million. Now, you will make a return of 12%. You will make a return of 12% if you hold a bond up to maturity. If you hold a bond up to maturity. Also, secondly, the assumption is every year the cash flow that you are getting, na guys, every year the cash flow that you are getting, I'm going to write this down. Very important. Very, very, very important. Every year, the cash flow that you are getting, you are reinvesting it. You are reinvesting it in the same bond. Is this statement clear for everyone? Is this statement clear for everyone, guys? Every year, the cash flow that you are getting, you are not keeping it with yourself. You are reinvesting in the bond. You are reinvesting in the bond. Okay? Only and only then, at the end of the 10th year, you would have made a return of you would have made a return of 12% year on year on a compounding basis. I'm giving you guys 1 minute. Read this statement thrice. This is very, very, very important. Let me know if you have any doubt about this. Let me know even if you have the slightest doubt about this. Is this clear for everyone, guys? Is this clear for everyone? Okay, Krusha is saying yes. What about others? Okay, perfect. 7. I'm just going to write this down. Just a moment. 8, 9, 10. Okay. So every year you are getting a cash flow of 100 million. Every year you are getting a cash flow of 100 million. Similarly, in the final year, you will get 100 million plus you will get 1000 plus you will get 1000. Okay. Now, your most important concept, that is, I will have to enlarge it. I'll have to say interest rate risk. Interest rate risk. Okay. Suppose you guys bought the bond when YTM was 12%. You guys bought the bond when YTM was 12%. Okay. And interest rate goes down. Your YTM goes down the next year. Your YTM goes down the next year. Okay. That is in year 1. YTM from 12%, it goes to 10%. Your YTM from 12% goes to what? How much does it go to? 10%. Okay? Like suppose, let me just, okay. So you are standing out here now. You are standing at year 1. Okay. You are standing at year 1 and YTM from 12%, it has gone down to 10%. Tell me something. What will happen to the price of the bond, guys? What will happen to the price of the bond? Will it increase? Will it decrease? Will it increase? Will it decrease? Price will increase. Price will increase. And what if YTM has increased from 12% to 14%? What if YTM has increased from 12% to 14%? From 12% to 14%. Can I say prices of the bond will decrease? Can I say price of the bond will decrease? Yes. So that means if you are holding the bond for a shorter time horizon, if you are holding the bond for a shorter time horizon, that means you had decided that you are going to sell it after a couple of years only. You had decided you were going to sell it after a couple of years. Okay, so you have a price risk here, because if YTM increases, prices of the bond will decrease. Is everyone crystal clear? What do we mean by a price risk? Is everyone crystal clear? What do you mean by a price risk? If you had decided your time investment horizon, that means you had decided that I am not going to hold it for 10 years. I am only going to sell it after a couple of years only. But if YTM increases in the market, you will get a lower price for the bond. That means you have a price risk here. Is that clear? Is that clear for everyone? Is that clear for everyone? Now, if second case, if you had decided here that you are going to hold the bond for a longer term, if you had decided you are going to hold the bond for a longer term, okay, you are planning to hold the bond up to 8 years or 9 years. Eventually, tell me, where will the price of the bond go to? Eventually, where will the price of the bond go to? Eventually, where will the price of the bond go to? Will it go to the face value? Yes or no? Eventually, will the bond trade at the face value? Yes or no? Yes. So if your if your investment horizon, was for a longer term, if your investment horizon was for a longer term, there you do not have any price risk. there you do not have any price risk. You have something known as a reinvestment risk. What do I mean by a reinvestment risk is, suppose you got 100 million out here as well. On the 8th year, you got 100 million year as well. Okay. Now, what did I say? You are not keeping this money with yourself. You are reinvesting it in the bond. You are reinvesting it in the bond. Okay. Now, suppose from 12%, on the 8th year, YTM has gone down to 7%. YTM has gone down to 7%. So all the cash flows that you have got till now for the 9th year, at what rate you will have to reinvest it at? At what rate will you have to reinvest it? If YTM has gone down, that means price of the bond has increased or decreased? That means price of the bond has increased or decreased? That means prices have increased. That means you will have to pay a higher price. Okay. So here you have something known as a reinvestment risk, because YTM has gone down in the market. YTM has gone down in the market. You expected you would invest your money at a 12% year on year, but right now you would only get 7% year on year. Okay. So all your coupon payments, you will have to reinvest it at 7%. Is that clear? What do you mean by a reinvestment risk? Is that clear, guys? So if, again, I'm going to repeat it again. If you're planning to hold a bond for a shorter term, you have a price risk. But if you plan to hold the bond for a longer term, eventually prices of the bond will always trade at face value. So there is no price risk involved. There is no price risk there. The only risk you have is reinvestment risk. There is a possibility that you might not get to invest more money in the bond at a 12% YTM. You would have to invest it at a 7% YTM. Is that clear for everyone? Is that clear for everyone, guys? Just for an example purpose, suppose you guys were standing at the 8th year. Suppose you guys were standing at the 8th year. Suppose you were standing out here. How do you calculate the price of any bond, guys? How do you calculate the price of any bond? How do you calculate the price of any bond? Is it the present value of future cash flows? Is it the present value of future cash flows? Yes. Yes or no? Yes or no, guys? Present value of future cash flows. Okay. Can you calculate the price of the bond if you are standing at 8th year? Do it quickly on the calculator itself. What would be the price of the bond if YTM was 12%? If YTM was 12%, what would be the price of the bond? If YTM was 12%. If YTM was 12%, what would be the price of the bond? I'm waiting for a minute. Is it 966.19? Is it 966.19? Is everyone getting 966.19? Yes or no? Is everyone getting 966.19? So basically, all the cash flows that you have got, you would invest at this rate only, 966.19. Okay. For 1,000 million, you would have to pay 966.19. For 1 million, you would have to pay around 0.96. For 10 million, you would have to pay around 96 million. Okay. So all the cash flows you would have invested at this rate. Okay. 966.19. But suppose from 12%, YTM has gone down to 7%. Now, can you calculate the price of the bond? Can you calculate the price of the bond? If YTM from 12% has gone to 7%, what would be the price of the bond here? Quickly. Is it 1054? Is it 1054? That means you would have to pay a higher price now. Yes or no? For the same cash flows. You would have to pay a higher price now for the same cash flows. Yes. So you are technically reinvesting at a very higher rate. Yes or no? You are reinvesting at a higher rate. Yes or no? This is known as your reinvestment risk. Is that clear? What do you mean by a price risk and what do you mean by a reinvestment risk? Okay, perfect. Now, what do you mean by, like, you know, in this whole bond, there is one point. Like you would tell me, Azam sir, you are telling me if I hold a bond for a shorter period, I have a price risk. If I hold a bond for a longer period, I have a reinvestment risk. So what should I do? What should I do? There is one point where there is like you, in this whole bond, there is one point where like you will escape the price risk also, and there will be no reinvestment risk as well. Okay, there is one point in this bond. Till what time should you hold a bond where you do not face any risk? Till what time should you hold a bond where you are not exposed to any risk? That point, how do you calculate that? That point is something known as Macaulay duration. How do you calculate that? Is something known as Macaulay duration, where you are not exposed to price risk. Along with that, you are not exposed to reinvestment risk as well. Is that clear? What do you mean by Macaulay duration? Is that clear for everyone? Now, Macaulay duration. Okay, let me write it down. Macaulay duration. There are actually two ways to understand Macaulay duration. Okay, even in your curriculum, they have explained you two ways. First way is, like I told you guys, how long should I hold a bond? How long how long should I hold a bond where I am not exposed to either price risk or reinvestment risk? Second definition is, in how many years? How long should I hold a bond so that I get my initial investment back? I get my initial investment back. Read the statement, guys, thrice. Okay, read the statement thrice, and I'll explain it to you. What is this? Like, how long should I hold a bond so that I get my initial investment back? Done. First example, suppose it is a zero coupon bond. It is a 3-year zero coupon bond. It is a 3-year zero coupon bond. 1, 2, 3. 1, 2, 3. 3 year zero coupon bond. 1,000 million is the face value. YTM is 7%. YTM is 7%. Can you tell me what would be the price that you would pay, or what would be the price that you would like? What would be your investment here? What would be your investment here? It is a zero coupon bond. Is it 81.63? 81.63? 81.63? Yes or no? 81.63? Yes, absolutely correct, Samruddhi. 81.629, 6298. Okay, so technically you will have to hold a bond for 3 years only to get your initial investment back. Is that clear? Yes. Yes or no? You will have to hold a bond for at least 3 years to get your investment back. Okay. So Macaulay duration would be 3 years. Macaulay duration would be 3 years. And 3 years is also like the second definition. How long should I hold a bond where I'm not exposed to either price risk or reinvestment risk? That is 3 years only. Okay. If you hold a bond up to 3 years, there is no price risk, there is no reinvestment risk as well. Okay. You will earn a return of 7% year on year on a compounding basis. You will earn a return of 7% year on year on a compounding basis if you hold a bond up to 3 years. Now, I will change this a little bit. This is where people start getting confused. Suppose I tell you there is a 5% coupon rate as well. 5% coupon rate. Okay, so let's just say 5% is 5. You get 5 million here, you get 5 million here, plus you get 5 million here, plus you get 5 million here. Now, can you calculate the price of the bond if when YTM is 7%? Can you calculate the price of the bond when YTM was 7%? Can you do that? Price of the bond when YTM was 7%? Is it 94.75? 94.75, yes or no? Is it 94.75? Now, can I say this thing? Okay, can I say you paid a price of 94.75, expecting a return of 7% year on year on a compounding basis. Compounding basis. Okay. You paid a price of 94.75 because you wanted to earn a return of 7% year on year on a compounding basis. Now, for that, you would have to reinvest your cash flow at the YTM. You would have to reinvest the cash flow at the new YTM. Okay. You do not know what the new YTM is going to be. You do not know what the new YTM is going to be. So now you want to find out till how many years should I hold a bond irrespective of how interest rate changes, but I make a return of 7% only. Am I clear with this? I'm going to write this down. How long should I hold a bond that I make a return of 7% only, irrespective of interest rate changes? How long should I hold a bond? Okay, I want to make 7% only. Okay, because that was my plan. I had paid a price because I thought I will earn 7%. Now, how long should I hold a bond so that I earn 7% only, irrespective of interest rate changes? Or second definition is, how long should I hold a bond that I get my initial investment back? Now, both, how long should you hold it? How will we get to know that? We will get to know that by calculating Macaulay duration. Is that clear for everyone? We will get to know that by calculating Macaulay duration. Clear है? What do you mean by Macaulay duration? Okay. So how do you calculate Macaulay duration is basically, how do you calculate Macaulay duration basically is, first what you will have to do is, you will have to find the present value of each and every cash flow. You will have to find the present value of each and every like suppose in this case, I'll give you a new we'll do a new example. Suppose bond face value is 1,000, 8% annual coupon, maturity 3 years, YTM 10%. So 80 is your coupon payment. You will have to calculate the present value of every cash flow. First year में you will get 80. Second year में you will get 80. Third year में you will get 1080. You will have to calculate the present value of that. I hope everyone knows how do you calculate the present value. Please guys, don't give me a shock right now. If you tell me, sir, how do you calculate it? Is there anyone who does not know how do you calculate the present value of cash flow? Please, I will faint out here. Your exams are there in a week. Okay. I will definitely faint out here if you tell me I do not know how do you calculate the present value of cash flow. Okay. So once you calculate your present value of 80 is 72.73. Present value of 80 after 2 years is 66. And present value of 1080 after 3 years is 811.4. Okay. Then what you will do is, you will calculate the weight. You will calculate the weight of this. How do you calculate the weight is, basically, what is the total present value of future cash flows, guys? What is the total? Is the total 950.24? Is the total 950.24? Yes or no? Yes. So the weight of first cash flow, 72.73 divided by 90 divided by 950.24. 72.73 divided by 950.24. Okay. Second one is 66.11 divided by 950.24. And third one is 811.4 divided by 950.24. You will calculate the weight. Whatever answer that you get, you will multiply this by 1, you will multiply this by 2, you will multiply this by 3. Am I clear? Because year 1, year 2, year 3. Year 1, year 2, year 3. Yes. Clear hai? Is it clear? How do you calculate the Macaulay duration? Is this clear? How do you calculate a Macaulay duration? I'm giving guys 2 minutes. Think about it and let me know if you have any doubt. So you get Macaulay duration as Krusha after calculating weight, the first weight you will multiply it by 1 because you are getting it in year 1. The second weight you will multiply it by 2 because you are getting that in year 2. The third weight you will multiply by 3 because you are getting that in year 3. And you will add everything. Okay. Seventy-two point seven three divided by 950.24 is 0.7653. You will multiply this by 1. You see, multiply this by 1. 66.11 divided by 950.24 is 0.06956. You will multiply this by 2. because you are getting in year 2. And third is 811.4 divided by 950.24, you get as 0.8540. You will multiply this by 3 because you are getting it in year 3. Then you will add everything. The answer is 2.78 years. So you will have to hold a bond up to 2.78 years to earn a YTM of 10%, to make a return of 10% irrespective of interest rate changes. Or the second definition is, the second way to define Macaulay duration is, you will have to hold a bond for 2.78 years so that you get your original investment back. Is that clear? Is that clear for everyone? Clear? Hai? Okay. Next we do is modified duration. Now, what does modified duration tell us? What does modified duration tell us? Let me just go and write modified duration 26 bold. Modified duration. What does modified duration tell us? Modified, tell me something, guys. Till now, what have we understood? If YTM changes, what will change along with it? If YTM in the market changes, what will change because of a change in YTM? What will have an impact? The price will have an impact. The price of the bond will change. The price of the bond will change. So I want to understand, if I am buying a bond today and if YTM tomorrow changes by 1%, if I am buying a bond today and if YTM changes by 1% tomorrow, how much will my bond price change in percentage terms? Is that clear? That is known as modified duration. I want to understand if tomorrow YTM changes by 1%, how much will my bond price change in percentage terms? Read the statement thrice. This is known as modified duration. This is known as modified duration. If I tell you, if I tell you modified duration is 2. If I tell you modified duration is 2, okay? And YTM increases by 1%. YTM increases by 1%. So how much will the bond price change by? How much will the bond price change by? Will the bond price increase or decrease, guys? Will the bond price increase or decrease if YTM increases by 1%? If YTM increases by 1%, bond price will decrease. How much will it decrease by? It will decrease by 2%. Is that clear? Is that clear for everyone? And if YTM decreases by 1%, my bond price will increase by 2%. Is this clear? What do we mean by modified duration? Is this clear? What do we mean by modified duration? Clear hai? Okay. Now to calculate modified duration, na guys, to calculate modified duration, they have given you two formulas to do it. To calculate modified duration, there are two methods. You will have to, there are two methods. Okay, you will have to solve it according to the question only. You will have to solve it according to the question only. Let me open the curriculum book 1 second so that I can show it to you. What are the two methods? Okay. The first method is, where is the formula for modified duration? Yeah. Can you see this one, guys? Modified duration is equal to Macaulay duration divided by 1 plus R, that is YTM. Okay? I'm going to write it down here. First method is, or you can copy this as well. So you can copy this as well. I'm going to make it in bold. Modified duration is equal to Macaulay duration divided by 1 plus YTM divided by M. Okay? 1 plus YTM divided by M. Now, what is M? Basically, M is basically how many coupon payments are you getting in a year. So if you want to calculate the modified duration of a semi-annual bond, you will YTM divided by 2. Is that clear? Is that clear for everyone? Is that clear for everyone? And the second method to calculate modified duration, the second formula to calculate modified duration is V minus V plus upon 2 into V0 into change in YTM. Now, if you have a question where they tell you, okay, the bond price increased to this value. Let's just say the bond price increased to 950. The bond price decreased to 850. The bond price decreased to 850. And you purchase the bond at 900. So V minus would be 950. Okay. V minus would be 9. Why minus? Because if YTM has decreased, value has increased, right? So if the question tells you the revised bond price, due to decrease in YTM is 950, you will keep V minus as 950 minus V plus is the change in bond price due to increase in YTM minus 850 divided by 2 into V0 into change in YTM. Okay. So if the question, like, I'll tell you how will the question come in. I'll tell you how will the question come in. Just give me a second, guys. Let me write down a question for you. Just a moment. Just give me a moment. Finding a question for you. Here. Do you see this question, guys? A bond with a face value of 1,000 pays an annual coupon of 5% and has 5 years to maturity. The current market price of the bond is 950. Interest rate changes. If the YTM increases by 1%, the bond price decreases to 930. If the YTM decreases by 1%, the bond price increases to 970. So according to the formula, V minus is 970 minus V plus is 930 divided by 2 into V0, that is 950, into change in YTM, that is bond. They have said it is increase. The change is 1%, right? The change is 1%. Okay, so I'll make this 1%. Can you quickly calculate this and tell me what would be the modified duration of the bond? What would be the modified duration of the bond? Okay, Krusha is saying 4.21. So sorry. 4.219. Is everyone getting around 4.219? I'm trusting Krusha has got it right. Now let me also just calculate it once. 1% into 950 into 2. 1% into 950 into 2. So 140 divided by this. 2.10, right? Tamanna, it will be 2.1053. 2.1053, that is your modified duration. Am I clear? But if the question tells you, if the question gives you Macaulay duration, which formula will you use? Which formula will you use? You will use this formula. Is this clear for everyone? Is this clear for everyone? Is this clear for everyone? Yes, Tamanna, check it again. I'm waiting for 2 minutes. Got it? Perfect. Now there is one major drawback of Macaulay of modified duration. There is one major drawback. The drawback is it assumes that percentage change in increase of the bond is the same as percentage change in decrease of the bond. Okay, what was the modified duration that we got in our case, guys? What is the modified duration that we got here? Was it 2.1? Was it 2.1? Was it 2.1? Yes. Was the modified duration 2.1? Okay. That means if YTM, that means, one sec, just give me a second. If YTM increased by 1%, price would decrease by 2.1%. Similarly, if YTM decreased by 1%, price would increase by 2.1%. This is what modified duration is telling us. Okay, but there is one major drawback, that the property of a bond is percentage change in increase of the bond will always be greater than change in decrease of the bond. I'm going to write this down for everyone. In practical world, percentage change in increase would be always greater than percentage change in decrease for the same change in YTM. For the same change in YTM. Read the statement twice, guys. I'm gonna tell you what is the solution then. Read the statement twice. That means in practical world, price of the bond has to increase by more than 2.1%. That is the property. That is how bonds work. Okay. So what is the solution then? How do I calculate how much will my bond price change for 1% change in YTM? How do I calculate it? How do I know my risk? Along with modified duration, I will also have to calculate convexity. Along with modified duration, I will also have to calculate convexity. Am I clear? Am I clear, guys? I'm going to repeat it again. Along with modified duration, I will also have to calculate convexity. How do I calculate convexity? They have given you, again, they have given you two methods to do it. They have given you two methods to do it. Okay? Like modified duration had two methods. Convexity also has two methods. Let me write it down. Convexity. I'm gonna make this bold. Okay. First method. How do you calculate convexity is, first you will have to use a direct, first you can use this formula, that is convexity of cash flow. Convexity of a cash flow is T multiply by T plus 1 divided by 1 plus R square. Please write this down. Please write this down. How do you calculate a convexity of a cash flow is T multiply by T plus 1 divided by 1 plus R square. I'm giving you guys 1 minute. Please write this down. Done? Done? Okay. Let us do one sum. Let us do one sum so that things get more clear now. Maturity is 3 years. 11% annual 11% annual coupon bond price is 85.7. Okay. Maturity is 3 years, 11% annual coupon bond. That is coupon rate is 11%. Can you calculate what would be the YTM quickly? Coupon rate is 11%. Annual paying. Can you calculate the YTM? What would be the YTM? What would be the YTM? Face value, will you take face value as 100 or 1000? Will you take face value as 100 or 1000? Please get this right, guys. Please. Otherwise, a deferral option is always there. Face value is 100 or 1000? Face value would be 100. Thank God. Face value would be 100. Okay. So YTM would be, Krusha is saying 17.52. Is everyone getting 17.52 as YTM? Is everyone getting 17.52? Is everyone getting 17.52? Okay. Now, in year one, let me write down here, write down here like this. In year one, what is the cash flow? Can I say cash flow is 11, guys? Can I say cash flow in year one is 11? Cash flow is 11. Yes or no? Cash flow is 11 in year one. Cash flow is 11. Quickly find the present value of this, guys. Quickly find the present value of this. 11. Quickly find the present value of 11. Quickly. Quickly find the present value. I'm gonna just write the table up till that time. Okay. Cash flow is 9.36. I am not calculating it. I am going by your word. 9.36. Okay. Now, how do you calculate the convexity is, how do you calculate the convexity for year one is T multiply by T plus 1, T plus 1 divided by 1 plus YTM the whole square. Okay. So year one ka convexity would be 1 multiplied by 2. 1 plus 1 is 2. 1 multiplied by 2 is 2 divided by 1 plus YTM the whole square. Can you guys calculate what would be the convexity for year one? What would be the convexity for year one? Quickly. 17.52 plus 1 square store 1 2 divided by. Come on, guys, you need to be quick. I think the convexity is 1.4481. 1.4481, yes or no? Is everyone getting 1.4481? Yes. Is everyone getting 1.4481? Quickly. I'm going to repeat it again. T is 1. 1 multiplied by 2. That is 1 plus 1 is 2. Okay. T is 1 multiplied by 1 plus 1 divided by 1 plus YTN, that is 17.52%. 17.52% raised to 2. Solve the denominator first. 1 plus 17.52%. 17.52% plus 1, that is 1.1752. The whole square, that is 1.3811. Store it in your store it in your one function. 2 divided by 2 divided by recall 1, कितना आ रहा है answer? What is the answer that you guys are getting? Is everyone getting 1.4481? No answers? Why? What happened, guys? Not able to find it? Not able to find it? I'm waiting for 2 minutes. Samruddhi, Tamanna, Krusha, Sachin. Did you guys get 1.4481? मुझे लगता है I'll have to do it only. Year 1 multiply by 1 plus 1 divided by 1 plus YTM. YTM is 17.52%. 17.52%. Bracket the whole square. So 1 into 2, that is 2, divided by, when I solve this, I get 1.3811. 1.3811. Okay. Similarly for year 2. Cash flow is 11. Can you guys calculate a convexity for year 2? Can you guys calculate a convexity for year 2? Year 2 ka basically it would be 2 multiplied by 3. 2 plus 1, 3. 2 multiplied by 3 is 6. 6 divided by 1.3811. 6 divided by 1.3811. Convexity, Sachin. Convexity. Is it 4.3444? Sachin has calculated the present value also. Thank you so much, Sachin. I'm going to write this down. Present value is 7.964. Sachin, year 3 present value is wrong. Year 3 present value is wrong, Sachin. Because cash flow would be 111. Cash flow would be 111 and not 11. Okay. Convexity for year 3. Convexity for year 3 is, I'll just change this into 3 multiply by 3 plus 1, that is 4. 3 multiplied by 4, 4 3s are 12. 12 divided by 1.3811. 12 divided by 1.3811. 12 divided by 1.3811. Convexity is 8.6887. 8.6887. Okay. And cash flow of year 3 is 68.389. 68.59. Now what you guys will have to do is, you will have to calculate the weight of your present value. You will have to calculate the weight. That is, how do you calculate the weight is, I'm going to write this down. 9.36 divided by 85.7. Next year weight would be 7.964 divided by 85.7. And third year would be 68.549 divided by 85.7. Okay? I'm giving you guys 2 minutes. Think about it. Let me know if you have any questions about this. Okay? Think about it. Even the slightest doubt, let me know if you have any questions. Let me just write down 68.549. No questions? No questions? Krusha, unfortunately, there is no shortcut method. Okay? Only the question is slightly different, then you can use a shortcut formula. Okay, perfect. Then what you will do is, eventually, you will multiply this answer. You will multiply this by this. You will multiply this by this. And you will multiply this by this. And you will add up everything. You will get the convexity. Am I clear? Am I clear, guys? How do you calculate convexity? Am I clear? How do you calculate convexity? Yes. Am I clear? How do you calculate convexity? Okay, perfect. Okay. Next. The second method, like I said, guys, modified duration, there were two methods. Convexity also, there are two methods. The second method to calculate convexity is you have a direct formula. You have a direct formula. I'm going to write down the formula. Just give me a second. Direct formula is equal to V minus. Is everyone clear what is V minus, right? Plus V plus minus 2 into V0 divided by change in YTM, the whole square multiply by V0. Is this clear, guys? In this type of questions, V minus will be given, V plus will be given, change in YTM will also be given. You just have to calculate convexity. Am I clear? You just have to calculate convexity. Am I clear, guys? In the previous sum, you had to multiply each weight by individual convexity and add up everything to calculate convexity. In the previous method, you had to calculate each weight, multiply each weight of present value. Huh? Remember this, guys. Weight of present value. Multiply each weight of present value. Multiply that by the convexity of every cash flow. Convexity of every cash flow. Okay, and you add up everything. Am I clear? The second method is a direct formula. Now, once you have calculated duration, once you have calculated convexity, now I can completely understand. Let me share the notes with you, guys. Let me share the notes with you. Now I can completely understand that what if interest rate changes tomorrow, how will my bond price change? How will my bond price change? And the formula to calculate that is minus modified duration, minus modified duration into change in YTM, plus half multiply by convexity into change in YTM the whole square. Is that clear? Once you have calculated duration, once you have calculated convexity, you use this formula to find out कि अगर कल interest rate change होता है, if interest rate changes tomorrow, how much will my bond price change by? Is that clear? Why do we have modified duration and convexity also? Clear है? Is that clear for everyone? Okay. I think guys, take a quick 5 minutes break. Take a quick 5 minutes break. Think about the concepts of Macaulay duration, modified duration, and convexity. Okay, think about it. Have some water. If you guys have any questions about these three concepts till now, let me know. Or else we'll continue with effective duration and effective convexity, which is very simple. You have covered the hard part. Now effective duration and effective convexity is very simple. Okay. I'll see you guys in 5 minutes. Okay, welcome back, guys. Any questions till now? Think about it. 1 minute ले लो. Let me know if you have any questions. Krusha, you'll have to uh, like get it. First, Krusha, if you're confused with theory, understand it in the flow. Macaulay duration tells you in how many years you will get your initial investment back. Okay, how many years you will get your initial investment back, or Macaulay duration also tells you till how many years should I hold a bond, how many years should I hold a bond that irrespective of interest rate changes, I make a return of my original YTM. Okay, that is Macaulay duration. Now, suppose if you have bought a bond, if you have bought a bond and now you want to understand the risk, like tomorrow if interest rate changes by 1%, how do I know how much will my bond change by? So you will have to calculate modified duration and convexity. You will have to calculate modified duration and convexity. Clear hai? Now comes the third part. That is, suppose Kurusha is holding a callable bond. She is holding a callable bond. Can you guys tell me, in a callable bond, there is a possibility that a company pays back the principal early, yes or no? In a callable bond, there is a possibility the company pays back the principal early, yes or no? I'm going to write it. There is a possibility the company pays back the principal early, or in a putable bond, there is a possibility the investor returns the bond early. Yes or no? The investor does not sell it, it returns it to the company. The investor returns the bond early. Yes or no? Are these two cases possible? So can I say in both the two cases above, cash flow will change entirely? Yes. Can I say in both the cases above, cash flow will change entirely? Till now, we understood that the cash flow is going to remain constant. Till now, we have only considered the cash flow will remain constant. But in these two cases, can I say there is a possibility the cash flow will only change? Yes or no? So how do I calculate how much am I exposed to? How do I calculate that if interest rate changes tomorrow, what is my bond price going to change by? How do I calculate it? You will have to calculate effective duration and you will have to calculate effective convexity and use the both to calculate what will your bond price change by. Am I clear? Am I clear, guys? Again, a quick revision. Can you tell me why can you not only calculate effective duration? Why do we need effective convexity as well? Can you tell me? Quick revision. Why do you need to calculate both effective duration and effective convexity? And why not only duration would be sufficient enough? Because duration, no, Krusha, duration has a drawback. Duration takes into assumption that increase in bond, percentage increase in bond is same as percentage decrease in bond. Am I clear? That is the drawback of duration. And that is why duration is not sufficient enough. Am I clear, Krusha? So effective duration, how do you calculate it? Is V minus V plus. The formula is exactly the same. The formula is exactly the same. Divided by 2 into V0. Now, instead of change in YTM, we only have something as change in curve. Instead of change in YTM, we only have something as change in curve. Am I clear? Am I clear, guys? Instead of YTM, we only have change in curve. Is that clear? Now, along with this, you will have to calculate effective. You will have to calculate effective convexity as well. Again, the formula will stay the same. Again, the formula will stay the same as of convexity. That is V minus plus V plus minus 2 into V0 minus 2 into V0 divided by change in, instead of change in YTM, we are using change in curve. We are using change in curve, the whole square multiply by V0. Is this clear, guys? Is this clear? Is this clear? Now you will have to use this too. Once you have calculated your effective duration, once you have calculated your effective convexity, you can easily calculate the percentage change in bond price due to a change in the interest rate. Is that clear? Clear? Hai? Any questions? Giving you 2 minutes, think about it. Any questions till now? Any questions till now? Any questions till now? And what is the formula to calculate the percentage change in bond price using effective duration and effective convexity is, what is the formula? Again, the formula will stay the same. Percentage change in bond price is equal to minus effective duration multiply by change in curve plus, okay, so this is one bracket, plus the other bracket is half multiply by effective convexity, effective convexity, one sec, multiply by change in curve the whole square. Clear hai? For a normal bond, you will use, instead of change in curve, it will be change in YTM. If instead of effective duration, it would be modified duration. Okay. And for instead of effective convexity, it would be normal convexity. For bond with options, it would be effective duration and change in curve. Effective convexity and change in curve. Clear? Is the difference clear, guys? Is the difference clear? No? Prusha, do you have any doubt? Do you have any doubt, Krusha? Tell me, Samruddhi, what doubt do you have? No, no, it's clear. Okay. Now, finally, till now, guys, till now, we were only considering change in YTM, right? Till now, we were only considering change in YTM, yes or no? Yes or no? Till now, we were considering change in YTM. But what if? But what if? Okay. So basically, what happens is, I'll tell you basically what happens is, take it. Yeah. Let me just write down the new concept. Okay. Can I say we were, guys, when we talk about YTM, when we talk about YTM, that means that is we use the same rate to discount our cash flows, yes or no? We use the same rate to discount our cash flows, yes or no? Yes or no, guys? We use the same rate to discount all our cash flows. Yes or no, guys? Like, suppose there is a 3-year bond. Suppose there's a 3-year bond. 1, 2, 3. 1, 2, 3. Okay. And this is today. 100 million is the face value. 10% is the coupon rate. So that is 10 million, 10 million, and 10 million. Now, if I say YTM is 15%, if I say YTM is 15%, that means we are discounting every cash flow by 15% only, yes or no? We are discounting all the cash flows by 15%, yes or no? We are discounting this also by 15%. We are discounting this also by 15%. We are discounting this also by 15%, yes or no? Yes. But what if I tell you, the question tells you, okay, there is not one rate, there are individual rates. First year का cash flow, individual rate is S1. You need to discount this by S1. Okay. For second year cash flow, there is one individual rate you need to discount it by. That is S2. So this, you need to discount this by S1. You need to discount this by S2. And you need to discount this by S3. Okay. So YTM is basically an average of this. Okay. YTM is basically like an average of this. We are not going to get into detail how is it calculated, because that is not important. Because that is not important. Okay. YTM is basically an average of this. Now, if the question tells you that individual rate has changed, if the question tells you individual rate has changed, so now how do I calculate how much am I exposed to? Now, how do I calculate how much am I exposed to? Like, suppose if S1 and S3 are constant, only S2 has changed. How do I calculate how much am I exposed to? How do I calculate what is my risk? We will calculate using something known as key rate duration. Is that clear? How do I calculate? How do I calculate my exposure? Calculate my exposure to interest rate changes if individual rates have changed. Rate has changed. The solution is key rate duration. The solution is Key rate duration. So have we understood the order flow? Have we understood the order flow? First is Macaulay duration. Okay, Macaulay duration is how long should I hold a bond that my return is same as my original YTM? How long should I hold my bond that I get my initial investment back? That is Macaulay duration. How long should I hold my bond that irrespective of interest rate changes, I am earning the same rate as my original YTM? That is Macaulay duration. Now, आपको पता चल गया आपको होल्ड कितना करना है. But now you also want to calculate your exposure. Okay, if tomorrow after year one interest rate has changed, how much will my bond price change by? So you will have to calculate modified duration and convexity. Okay, you will have to calculate modified duration and convexity. But suppose Samruddhi is holding a putable bond where the cash flow is only not certain, where the cash flow cannot itself change. So how does she calculate her exposure? She will calculate her exposure to interest rate changes using effective duration, effective convexity. Using effective duration, effective convexity. Okay, but suppose Krusha, Krusha now also wants to understand that we are talking about an average rate. She wants to get into more detail. She wants to understand that if individual rate has changed, everything else is constant. Only if individual rate has changed, how do I calculate my exposure? How do I get to know how much will my bond price change due to individual rate changing? How will she do that? She will have to calculate key rate duration. Is that clear? Is that clear for everyone? Is that clear for everyone? Let us look at one sum in your curriculum. Let us look at one sum in your curriculum, CFA curriculum book. Okay, about key rate duration. One sec. Key rate duration. Paste. Okay. Key rate duration. Krusha, no, I didn't understand the part where you said effective and convexity use in key rate. Krusha, you'll have to type the question again. I'm not able to understand your question. I'm not able to understand your question, Krusha. एक काम करते हैं, Krusha, I'm gonna write it down again. ठीक है? I'm gonna write it down again. First, you got it? Like, suppose I want you to now like to let me summarize it once. Let me summarize it once. Summarize. Okay. I want you to assume. I want you to assume you are a bond. You guys are a bond investor. You guys are bond investors. Assumption. You guys are bond investors. You guys are bond investors. Okay. What risk are you exposed to? Can you guys tell me what risk are you exposed to? What risk are you exposed to? What risk are you exposed to? Can I say interest rate changes? Yes or no? Interest rate changes or YTM changes, yes or no? Yes? Yes? Okay. Now, first case. Suppose Krusha invested in a bond when YTM was 7%. So she thought, she would make 7% year on year on a compounding basis. Okay. She thought she would make 7% year on year on a compounding basis. Now, if tomorrow YTM has changed in the market, she will have to reinvest the coupons at a different rate. Yes or no? She will have to reinvest the coupons at a different rate. If YTM changes tomorrow, she will have to reinvest coupons at a different rate. Yes or no? Now if she has a question, till what time should I hold a bond so that my return is 7% only year on year, irrespective of changes in YTM? इसका आंसर कौन देगा? Who will give the answer? Who will give this answer? How will she calculate? How will she know till what time till what time should I hold the bond so that my return is 7%? How will we know that? What is the solution? What is the solution? How would Krishna know that? How would Krishna know that? Solution is Macaulay duration. Solution is Macaulay duration. Am I clear? Am I clear? Solution is Macaulay duration. Macaulay duration also tells you in how many years, it also tells you in how many years do you actually get your initial investment back. In how many years do you actually get your initial investment back? Am I clear? Am I clear, guys? Now, Krusha also wants to understand, Krusha also wants to understand if tomorrow YTM changes, how much will my bond price change by? How much will my bond price change by? What is the solution? What is the solution? What is the solution, guys? Think about it and let me know. What is the solution? What is the solution? It is modified duration. It is modified duration plus convexity. Am I clear? It is modified duration plus convexity. Is that clear? Is that clear, guys? Modified duration is not sufficient enough. Modified duration is not sufficient enough. Why is it not sufficient enough? Because it takes into assumption that percentage increase is same as percentage decrease for the same change in YTM. So that is why we need to calculate convexity as well. Okay. And but now Krusha forgot one thing. Krusha forgot one thing. She is holding a callable bond. She is holding a callable bond. Now she wants to understand if tomorrow YTM changes, how much will my bond price change by? What is the solution to this, guys? What is the solution? What is the solution? What is the solution? Can you tell me what is the solution now? Effective duration and effective convexity. Effective duration plus effective convexity. Clear? Is this clear? Have you guys understood the terms? Understanding the terms is important. Once you understand the terms, questions will be this easy. Questions will be this easy. Once you understand the terms. Is this clear? Effective duration and effective convexity? I have, there are around 7 people watching right now. Give me a yes or a no in the chat box. Okay, yes. What about others? Okay, Krusha, Samruddhi are saying yes. Anyone else? Okay, Abhirup is also saying yes. Perfect. Now, one last final thing. One last final thing, that is like Krusha now suppose Krusha is getting into more detail. ये इसने तो she has taken a broader perspective. She is getting into more detail now. She is getting into more detail now. Krusha wants to get into more detail. Into more detail. Okay? She wants to understand. She wants to understand that if tomorrow only individual rate has changed. Individual rate has changed. What do you mean by individual rates? What is the term for individual rates, guys? Please get it right. What is the term that we use for individual cash flow rates? What is the term that we use for individual cash flow discount rates? Individual discount rate has changed. It is known as spot rates. It is known as spot rates. She wants to understand if tomorrow individual rate has changed, okay, not the whole, not the YTM, but individual rate has changed, how much will my bond price change by? Solution is key rate duration. Solution is key rate duration. Order flow समझ में आ गया सबको? Has everyone understood the order flow? Has everyone understood the order flow? Any questions, guys? Any questions? Any questions? ले लो 2 मिनट ले लो सोच लो अच्छे से ये ऑर्डर फ्लो एंड लेट मी नो इफ यू हैव एनी क्वेश्चंस No? No questions, guys? No doubts? ठीक है. In these readings, that we have completed, is there any other specific concept you want me to cover? Is there any specific concept you want me to cover, guys? In these 3 to 4 readings, is there any specific concept you want me to cover? Analytical duration and analytical duration and empirical duration. Analytical duration and empirical duration. Okay, just give me a second. Fixed in. I'll just share the notes with you. Just a moment. Okay. Can you see analytical duration? This is the type of duration we have been using so far. Okay. That is like whatever durations that we have calculated till now, we have analyzed it. It is based on maths and models. It is based on pricing formulas. And the assumption is only benchmark interest rates have changed. Okay. That whenever we were talking about YTM changing now, whenever we were talking about YTM changing, okay, we were taking to assumption that your government rates were changing. Okay. Government yields were changing while credit spread stays the same. I'm going to repeat it again. Till now, whatever duration that we have calculated, that is modified, convexity, okay, effective duration, effective convexity, key rate duration, it has been based on maths and models. Okay, so these are part of analytical duration only. Samruddhi, clear hai? What do you mean by analytical duration? All these are part of analytical duration. That is what we have been analyzing. Clear hai, Samruddhi? The assumption is that only benchmark interest rates, that is government yields, have changed while credit spreads have stayed the same. Okay. But in real market, okay, what happens? Okay. Empirical duration based on actual historical data, not formulas. It measures how a bond price really behaved in the past when benchmark yields changed. Okay. It captures the combined effect of benchmark interest rate changes and credit spread changes. So you can say empirical duration is a more accurate version. Empirical duration is a more accurate version. Now, what is our assumption basically is, what was our assumption basically is, when we used to say that YTM has decreased by 1%, when we used to say YTM has decreased by 1%, our assumption was government yields also have gone down by 1%, corporate bond yields have also gone down by 1%. Am I clear? Am I clear, guys? Samruddhi, Krusha? अभी रुक. So when we used to calculate that, if I'm going to repeat it again, when we were calculating modified duration, and when we were talking about YTM changing by, let me write it down, YTM increasing by 2%, YTM increasing by 2%. Now in this, our assumption was the government YTM has also increased by 2%, and corporate, your credit spread has also increased by 2%. Am I clear? That was our assumption. Am I clear? But that is always not the case. That is always not the case. Example is flight to quality scenario. Let's say the market is panicking. Let's say the market is panicking during a financial crisis. So investors rush to save government bonds. Their yields fall, but corporate bonds are seen risky. Their credit spread rises. Okay. Now, analytical duration would wrongly predict a big price increase for corporate bonds because it assumes spread did not change. Am I clear? Am I clear? Because when you were only assuming that YTM has decreased. You were only assuming YTM has decreased. In analytical duration, we completely ignore what has happened with corporate bond yields. We completely ignore what has happened with corporate bond yields. Am I clear? Am I clear? Till now, whatever we have understood, that is only good on theory. That is not how practical life works. That is only good in theory. That is not how practical life works. Because why is it only good in theory? Because we were only taking into consideration change in government YTM. Am I clear? Okay. Empirical duration would capture this correctly because it is based on actually what has happened in the past. This is the only explanation. This small explanation is only given to you. You do not need to get into detail about this. Okay. So while stable market, and if you are calculating for government bonds now, then analytical duration is correct. Okay. If the market is stable and you are calculating your interest rate exposure, if you have bought government bonds, then analytical duration is fine. But if the market is unstable and if you have bought Reliance ka bond, or if you have bought Adani ka bond, okay, then analytical duration can give you a wrong picture. Clear hai for everyone? If you have bought BJP ke bonds, government ke bonds, and you want to calculate your exposure, then whatever that you have calculated till now, that was fine. Okay. But if you have bought, let's say, Adani ke bonds, and the market is also not stable, then those duration will give you a wrong picture. Is that clear for everyone? Is that clear for everyone? That is the only explanation. So analytical duration is basically duration calculated based on formulas. Yes, Krusha, I will share it on the level 1 August group. Okay, Krusha? I will share this. I'll share these notes on the level 1 August group after we are done with the session. Okay? Any more questions you have about duration? Any more questions you have about duration and convexity? Any more questions, guys? Sanchita, just give me a second. Key rate duration. Just give me a moment. Sanchita. I'll need to find a sum for key rate duration. Let me see if there is any sum in the curriculum. Key rate on the basis of key rate duration. They have not given any sum as such in the curriculum also. Okay. What they have given as an explanation, let me share let me share my notes with you guys. Let me share my notes. Yeah. Can you see this? What is key rate duration? It tells us how sensitive the price of a bond or portfolio is to change in yield or to change in yield of one specific maturity. Okay. Like how do you calculate? How is key rate duration calculated? Is for each and every cash flow. For each and every cash flow, you will first calculate the modified duration of the cash flow. You will first find out the modified duration of the cash flow. Okay, multiplied by the weight. Okay, assign this value to the key rate closest to the cash flow times. Okay, a cash flow due in 5 years contributes most to the 5-year key rate duration. I think there is no sum as such. Do you have any sum with you, Sanchita, so that I can solve it and let you know? Do you have any sum with you? Yes, Sanchita, they have not explained it in detail. Basically, like if one sum I can think about is, let me just write it down. Okay, let me just write it down. Suppose question, we have a 5-year zero coupon bond. We have a 5-year zero coupon bond yielding 5%. We have a 5-year zero coupon bond yielding 5%. Now, if the fifth year, if the fifth year yield has increased by 50 basis points, what would be the key rate duration? What would, how, like, suppose you have, okay, suppose you have a 5-year zero coupon bond, YTM is 5%. YTM is 5%. Let me write it down. YTM is 5%. Okay. We have a 5-year zero coupon bond. YTM is 5. Now everyone needs to get this right. What would be the Macaulay duration here? What would be the Macaulay duration? Macaulay duration कितना होगा? What would be Macaulay duration? Can someone tell me what would be Macaulay duration in a zero coupon bond? What would be Macaulay duration? Quickly. Let me draw the timeline also for you. Let me draw the timeline also. This is your 5-year. This is your 5th year. This is today. And you are getting 100. Okay, you are getting 100 million. Macaulay duration would be 5 years only, right? Because you will have to hold the bond up to 5 years to at least get your initial investment back. Yes or no? Macaulay duration would be 5 years only. Yes or no? Yes or no? Yes or no, guys? Macaulay duration would be 5 years. Okay. Now, after this, calculate your modified duration. Modified duration. Formula for modified duration is Macaulay duration divided by 1 plus YTM divided by 1 plus, where is the plus sign? Oh my God, where is the, yeah. What is the modified duration now? What is the modified duration of this bond, guys? What is the modified duration of this bond? Let me calculate it. Macaulay duration is 5 divided by 1.05. Is it 4.7619? Is it 4.7619, guys? Okay. Can you find the present value? Can you find the present value of this bond? Sorry, present value of 100 million. What would be the present value of 100 million? What would be the present value of 100 million of fifth year cash flow? What would be the present value of fifth year cash flow? What would be the present value of fifth year cash flow? Quickly. Is it 78.35? 78.35, yes. Now key rate duration का formula, guys. Key rate duration का formula is modified duration multiply by weight of each cash flow. Okay. In this case, weight of 0, weight of 1, weight of 2, weight of 3, weight of 4 would be 0 only. That is why we have not calculated it. Otherwise, what you would do is you will calculate the modified duration of year 1. You will calculate the modified duration of year 2. You will calculate the modified duration of year 3. You will calculate the modified duration of year 4 and of year 5. You will multiply it by the weights. In this case, guys, key rate duration, modified duration is 4.7619 multiply by 70. Sorry, what is the weight? 78.35 divided by 100. 0.7835. 0.7835. कितना आ रहा है? कितना आ रहा है ये? Key rate duration का formula is modified duration multiplied by the weight. Okay. But now, if you have two bonds in your portfolio, let me just see it in your curriculum. One sec. Where is your curriculum? Till in that we were only considering one bond in our portfolio. If you have two different bonds in a portfolio, okay, how do you calculate is, let me show it to you. Key rate duration, na guys, it is more important in your like it is explained in detail in your level 2. Okay, level 1 it has only explained the basics, and also there were not a lot of sums in your institute in your portal also to calculate key rate duration. You see, they have calculated modified duration for every cash flow. Okay, they have calculated modified duration for every bond. Okay, there's a 2-year bond, there's a 5-year bond, there's a 10-year bond. Okay, they have calculated the modified duration, and what they have done is, I will tell you how they have calculated key rate duration now. Suppose you have invested 99 million, you have invested 99 million in 2 years bond, total investment in 276. Can you guys calculate what is the weight of your investment? Can you guys quickly calculate what is the weight of your investment? Can you guys calculate what is the weight of your investment? Quickly. I'm going to repeat it again. You have a portfolio, you have a government bond portfolio, okay, where there's a 2-year bond, there's a 5-year bond, there's a 10-year bond. Okay, you have invested, position size is 99, 93, 84. 99, this is a price that you have paid. Okay, 99, 93 and 84. Total you have invested 276. Calculate the weight of this bond, 2-year bond. Calculate the weight. Can you calculate the weight of this quickly? Can you calculate the weight of this? I'm going to calculate it with you. 99,006,219 divided by 276, 975, 424. Are you guys getting 0.3575? Are you guys getting 0.3575? Are you guys getting 0.3575? The weight multiplied by the modified duration, guys. Multiplied by the modified duration. You will get the key rate duration. Am I clear? Am I clear, guys? Multiplied by the modified duration, you will get the key rate duration. Am I clear? So remember one thing, guys. Again, we can see to calculate how do you calculate key rate duration now. They will always give you a portfolio in which there will be bond 1, bond 2, bond 3. Bond 1, bond 2, bond 3. I'm going to write it down. Just give me a second. Whenever you have a question based on, how do you calculate key rate duration is, okay, you will be given a portfolio. Let's just say you are given a portfolio. We'll solve one sum together. Given a portfolio with three bonds. With three bonds, okay, and you will be given the weight also. Like if you have invested equally in those three bonds, if you have invested equally in those three bonds, what would be the weight of every bond, guys? What would be the weight of every bond? What would be the weight? What would be the weight? You are given a portfolio with three government bonds. If you have invested equally in those three bonds, let's just say you have invested in 1 year government bond. Okay, you have invested in 1 year, 5 years, and 10 years. Okay, so the weight would be 33%. Okay, it would be 33%. Yes, you will multiply with that 33%. You will multiply this 33%, okay, into the modified duration of year 1 bond. You will multiply 33% into the modified duration of year 2 bond. You will multiply 33% you will multiply it by the modified duration of 10-year bond. Am I clear? Am I clear, guys? Am I clear? So what you will get is the key rate duration. You will get is the key rate duration. And how do you calculate the final answer is? Okay. Once you get the key rate duration now, once you get if they tell you the 5-year spot rate has changed, if they tell you the 5-year spot rate has changed, okay, you will multiply that key rate duration, multiply by the change in the rate, okay, and you will add up everything. Like, let me go to the curriculum example once more. Okay. Do you see here, guys? They calculated key rate duration for all three. Yes. Calculated the weight, multiply by the modified duration, calculated the key rate duration. Okay. What was the total, guys? What was the total of this? 5.368. 5.368. Now, let me see if they have explained. Okay. Perfect example. Can you see this, guys? Individual rates have changed. Perfect example. Can you see individual rates have changed? Give me a yes or a no. Can you see individual rates have changed? Quickly, give me a yes or a no. Can you see individual rates have changed? Yes, perfect. Okay, so key rate duration 0.645 multiply by 23 basis point. ये तो सबको पता है ना? 100 basis point is how much? 100 basis point is 1%. So 23 basis point is 0.23%. 0.23%. Okay. 0.23%. So 0.23% is 0.0023. So 0.645 multiplied by 0.0023, that is 0.148. Okay. Similarly, they have you multiply key rate duration. Yeah. Yeah. Similarly, you multiply 25 basis point by 1483, 18 basis point by 2.158, and 10 basis point by 2.982. Am I clear? Clear है? Key rate duration, key rate duration. Always remember, they will give you a portfolio with government bonds only. Remember that there will not be corporate bonds and key rate duration. They'll only give you. Why will they give you government bonds only? Can someone tell me why will they give you government bonds? What is the rationale behind it? A portfolio with government bonds only. What is the rationale? What is the rationale? Why would it mostly be a government bond only? Because we are using change in the spot rate, right? We are calculating our exposure to change in the spot rate, right? Yes or no? And spot rates come from government bonds only. Okay. Any more questions, guys? Any more questions regarding durations and convexity? Any more question? Again, can you see this, guys? Can you see this? In this also, they have given you bond A and bond B. Okay, they have directly given you key rate duration. Okay, so how do you calculate is for bond A, okay, for bond A minus 2.702, 5 years का 5 years ही देखोगे आप, 5 years का 5 years ही देखोगे, multiply by 1.5%, 3.953. Take minus, huh? Don't forget to take minus 3.953 multiply by 10-year का rate. Okay, you will calculate this, and based on this, guys, based on this, okay, which one has a higher, which one is more volatile, which one is more volatile, bond A or bond B? Which one is more volatile, bond A or bond, or which one, which will have a greater percentage change? It is bond B, right? 7.91%. Okay. So this is the only sum that they've given you in your key rate duration. आपको और डिटेल में नहीं जाना है. Key rate duration simple है, ठीक है? Multiply the weight of investment multiplied by the modified duration, you will get the key rate duration. You will get the key rate duration. And अगर let's just say again simple करते वापस करते, एक वापस last sum will do it. Suppose you have been given a portfolio with with four bonds, okay, and you are equally invested in those four bonds. You are equally invested in those four bonds. Those four bonds are 1 year, 3 year, 5 year, and 10 year. Okay, 1 year, 3 year, 5 year, and 10 year. I'll just give you the modified duration. Huh? Just randomly, I'll give you the modified duration. 1 year का है, let's just say modified duration is 2. 3 year का है 3. 5 year का है 4. एंड 10 year का है 5. ठीक है, so you will multiply the weight by the modified duration to get what? To get what? You will multiply the weight by the modified duration to get what? What will you get? You will multiply the weight by the modified duration. You will eventually get, you will get key rate duration by that. You will get key rate duration by that. Now the question says, the change in rates are as following. Are as following. One year ka it is given plus 25 basis point. 1 year ka plus 25 basis point. 2 year ka, sorry, 3 year ka plus 50 basis point. 5 ईयर का प्लस 75 बेसिस पॉइंट एंड 10 ईयर का प्लस 100 basis point. So whatever key rate duration you get for year one, okay, that would be my 25 basis point multiply by minus key rate duration of year one. Am I clear? Am I clear, guys? 50 basis point multiply by minus key rate duration of which year? Year 3. 5 year 75 basis point multiply by minus key rate duration of year 5 and 10 year का 100 basis point multiply by minus key rate duration of year 10. Is that clear? Is that clear, guys? Any more questions? Any more questions? So I'll forward the empirical and analytical duration notes with you. Any other concept you want me to cover, guys? Any other concept? Is there any other concept which you want me to cover? The other readings are theoretical readings, very easy. Not much to discuss. I would suggest you guys to solve questions as much as possible. Okay. Now don't waste a lot of time in understanding the theory. Solve as many as questions as possible. Okay. Collateralized loan obligation and collateralized mortgage obligation, Krusha. Okay. Let me share. I'll have to share my notes with you. Just a moment. I'll just close this. I'll close this. Can you tell me, can you tell me which is the, in which, what is subject name for that? So that I share my notes and becomes more easier. What is the subject name? That let me check. Collateralized loan obligation and collateralized debt obligation. The mortgage-backed security, right? Mortgage-backed security. Okay, just a moment, Krusha. Mortgage-backed security. Okay, so mortgage-backed security, first thing you need to understand is mortgage-backed security. Remember one thing, what is mortgage-backed security? ICICI Bank has 10 home loans. ICICI Bank has 10 home loans. Okay. Now they will get the interest and principal in the next 15 years. They do not want to wait so much because there's a lot of demand for more loans. What they will do is they will sell their loans, guys. Loans are assets for a bank, yes or no? Loans are basic. Home loans are assets for a bank, yes or no? Yes or no? Okay, so they will sell their assets to a special purpose entity. They will sell their assets to a special purpose entity. And how will the special purpose entity buy those assets? Is by raising capital through something known as mortgage backed security. Are we clear with what do you mean by mortgage backed security? So how does it work is, we have ICICI Bank out here. We have ICICI Bank. It will sell its assets to a special purpose entity. And how will the special purpose entity get the money to buy those loans? It will raise bonds. It will raise capital through bonds. Such bonds are known as mortgage backed security. ये clear है सबको? Okay, now, uh, Krusha, I think prepayment risk is more prepayment. What do you mean by prepayment risk is, suppose uh, people who have taken a loan, they have prepaid their loan early. They have prepaid their loan early. So investors would be thinking कि मुझे तो interest मिलेगा for the 15 years, for the next 15 years. But suppose if someone is smart enough and he has prepaid the loan early, that means investor will not get the return, will not get the interest for the next 15 years now. Okay, so that is known as a prepayment risk. That is known as a prepayment risk. Okay, prepayment risk, you have contraction risk, that is cash comes in too early, and you have extension risk, that is cash comes in too late. So think of MBS like a callable bond also. Callable bond में भी वही होता था ना guys. The company used to pay the principal early, so that they don't have to pay further. They do not have to pay interest further on. Yes or no? So you can think of it like a callable bond. Okay. So this was very, very easy. Time, like what is the solution? Time tranching. Okay. I think I've shared the notes also with you guys. You can just read through it once. This is very simple. The thing, let us go to CLO and CMO. Collateralized loan obligation, collateralized mortgage obligations. Okay. Just a moment. Okay. So a residential, what do you mean by a residential mortgage? Is a residential mortgage is a loan where the collateral is a home. If the borrower can't repay, the lender has a legal right to take the property through foreclosure, sell it and recover the amount owed. These mortgages form the base of residential mortgage backed security. Okay? Matlab, the bonds that SPE issues when when the collateral is residential mortgages, that is known as RMBS, residential mortgage backed security. Okay, loans can also be of many type now. It can be a commercial property also, it can be a residential property also. Okay, now prepayment, there's also a prepayment penalty. Like if someone prepays the loan early, they have to pay a penalty to it. They have to pay a penalty. Recourse and non-recourse loans. Recourse loans are basically can go after borrowers' other assets if foreclosure doesn't cover the debt. मतलब अगर टाइम से पैसा नहीं दिया, तो not only the home, the investors can also go for other assets. Okay, that is known as recourse. Non-recourse mein that is not possible. नॉन रिकोर्स में दैट इज नॉट पॉसिबल. सो डिफॉल्ट के केसेस किसमें ज्यादा होंगे? डिफॉल्ट केसेस वुड मोर बी इन नॉन रिकोर्स लोन. Now, how do you calculate loan to value ratio? This is also very simple. Loan amount divided by the property value. Uh, Guys, like if the numerator is more, if the numerator is more, if the loan amount is more, is that more risky, less risky? Is that more risky or less risky? If the numerator is more, is that more risky or less risky? It is definitely more risky. If the loan amount is less, that means LTV is low. That means in a person who has bought a property now, he has taken a small loan on that. He has taken a small loan on that. So default chances are also low. Okay. Similarly, debt to income ratio, higher the debt, higher the chances of default. Lower the debt, lower the chances of default. Okay. Now RMBS is divided into two types. Okay, it is divided by agency and non-agency. Agency and non-agency. Okay, when RMBS is issued by Ginnie Mac, Fannie Mac, and Freddie Mac, okay, that is agency. Matlab it has a government backing. Non-agency is they don't have a government backing. So lower credit risk, higher credit risk. Credit enhancements not usually needed, often uses tranching, insurance, or reserves. What do you mean by credit enhancements? What do you mean by credit enhancements is basically वो कैसे होता था? क्लास ए, क्लास बी, क्लास सी बॉन्ड्स ट्रांचेस में बनते थे. ओके, सो एजेंसी आरएमबीएस में क्रेडिट एनहांसमेंट्स इज नॉट नीडेड, नॉन एजेंसी में इट इज नीडेड. ओके, लोन स्टैंडर्ड्स. नाउ सिंस इट इज गवर्नमेंट बैक ना, तो द लोन कौन से लोन्स का मैं आरएमबीएस बनाऊं? Which loans should the SP also buy? Even those have strict rules and regulations के borrower कौन है, लोन कितने का है. Okay, non agency RMBS में those rules and regulations can be a little bit lenient. Okay. After 2007-2009, non-agency RMBS declined sharply because of defaults on subprime mortgages. Okay, next is our types and characteristics of RMBS. Now, RMBS, residential mortgage-backed security, they are divided into a few types. Okay, pass-through and CMO. What do you mean by mortgage pass-through? Basically, मैं आपको बताता हूँ, सिंपल है. This is HDFC Bank. It has issued 100 residential loans. It has issued 100 residential loans, but requires more funds due to demand for more loans. Okay, so what will HDFC Bank do is it will sell these loans, 100 loans, to some SP, to SPE. And how will the SP get the money to buy those loans? How will like HDFC Bank will say, I have 100 loans of 1 crore each. You pay me 95 crore, you pay me 90 crores right now. All the future payment are yours. You pay me 95 crores, 90 crores right now. All the future payment are yours. How will the SPE get that 90 crore is? It will issue bonds. What are these bonds known as? Residential mortgage backed security. Residential mortgage backed security. Now residential mortgage backed security के अंदर भी दो टाइप आते हैं. First is mortgage pass through, or it is known as CMO, collateralized mortgage obligation. We are going to understand what that is. Mortgage pass through security Investors receive monthly cash flows from the underlying pool of mortgage loans. Cash flows include scheduled interest payments, scheduled principal payments, or any prepayments. Pass through matlab, it means the cash flows from the mortgage pool are passed directly to investors minus the fees charged, okay, by the SP. Okay. Now, what are CMOs? CMOs are more structured version of RMBS that divide the cash flows into tranches. Basically, हमारे previous case में एक pool बना है 100 home loans का, 100 home loans का. अब इसमें से जो भी पैसा आएगा अगर डायरेक्ट इन्वेस्टर्स को गया, ठीक है, तो दैट इज नोन एज पास थ्रू सिक्योरिटी, मॉर्गेज पास थ्रू सिक्योरिटी. दैट इज नोन एज मॉर्गेज पास थ्रू सिक्योरिटी. बट सपोज ये बॉन्ड्स में भी ना देर आर डिफरेंट ट्रांचेस. There are different tranches. That is tranche, like there are different tranches. That is tranche A and tranche B. Tranche A and tranche B. तो ट्रांच ए वालों को ना स्टार्टिंग में प्रिंसिपल नहीं चाहिए, सिर्फ इंटरेस्ट चाहिए. तो इसमें से जो इंटरेस्ट आएगा वो सिर्फ जाएगा ट्रांच ए को. अगर सिर्फ समवन हैज पेड अ प्रिंसिपल, वो जाएगा ट्रांच बी को. एम आई क्लियर? सो देयर आर डिफरेंट ट्रांचेस फॉर्म्ड so that investors can invest according to their own what do you say, according to their own goals. We'll read it further. CMOs are more structured versions of RMBS to divide the cash flows into tranches to better suit different investor needs. Purpose to redistribute prepayment risk, attract investors with different risk preferences. Okay. Now, basic CMO structure is based on one or more pass-through mortgage-backed security pools sliced into tranches. All tranches get interest, but principal is paid in a specific order. Principal is paid in a specific order. Sequential pay. Tranche 1 is paid all the interest first. Only after tranche 1 is fully paid, tranche 2 begins receiving principal. Tell me something, guys. If tranche 1 is paid all the principal first, do you think they will get any interest after that? What do you think, guys? Do you think they will get any interest after that? Do you think they will get any interest? If suppose Samiksha is an investor of tranche A, I am an investor of tranche B, and let's just say कृषा ने अपना होम लोन पे कर दिया है. कृषा ने होम लोन पे कर दिया है, तो जो अमाउंट पे किया है वो सबसे पहले जाएगा समीक्षा को. आई विल नॉट गेट दैट अमाउंट बिकॉज आई एम अ ट्रांच बी इन्वेस्टर. सो समीक्षा तो टाटा बाय बाय, शी विल नॉट गेट एनी रिटर्न्स आफ्टर दैट. Okay, whatever other people, when they are paying interest, that will come to me. Are you clear that this tranches does not happen in a mortgage pass through? It happens in collateralized mortgage obligation. Okay, when the bonds issued are of different tranches, that is known as collateralized mortgage obligation. Okay, so shorter tranche, but Samiksha ko advantage kya hai ki there is a very less chance of default. There's a very less chance of default. Okay, I have a risk of, like, हो सकता है investors बाद में pay ही ना करे. I won't get my money back. Okay. So Z tranche, principal only tranche, interest only tranche, floating rate tranche, inverse floater. Okay, these are some terms which you just need to read it through once. So MBS, mortgage-backed security versus collateralized mortgage obligation. What is the difference? What is the difference? Every investor shares the cash flows equally. You don't know exactly when you will get your principal back because it depends on when homeowners pay or refinance their loans. But every investor will get the same cash flow. But collateralized mortgage obligation, it is in a specific order. tranche A will get all the principal payment first, then tranche B, and then tranche C. Okay. Krusha, is it clear? What do you mean by a CMO? Is it clear what do you mean by a CMO? CMO clear hai, Krusha? Okay. Now, I think the next question you had was CLO, collateralized loan obligation, right? Let's do one thing, guys. Let me also have some water. Okay. You guys also have some water. Let us resume in the next 5 minutes. We'll understand what do you mean by a CLO, collateralized loan obligation. And if you guys have any questions, let me know so that I can solve it and I can explain it to you in as easy way as possible. Okay. See you guys in 5 minutes. Okay, welcome back, guys. Am I audible? Let us quickly wrap it up now. Am I audible, guys? Give me a yes or a no, quickly. Am I audible? Okay, perfect. देखो, to sum it up ना, to sum it up everything, to make it very easy ना, ठीक है? Let's just assume we have first is we have ICICI Bank. ICICI Bank. Now, ICICI Bank ना, it has उसके उसके बुक्स में there are 100 credit card loans. There are 100, there are there are 50 home loans. There are 75 uh bonds. There are 75 uh 75 bonds, or I would to be very specific, which bonds now? Uh corporate 75 corporate bonds, and there are let's just say 25 leverage loans. Leverage loans are basically very risky loans. Matlab, they are the most riskiest loans. Okay, ICICI Bank has all this now. ICICI Bank has all this. Now there is one SPE. There is one SPE. Okay, if it creates a pool only of 100 credit card, if it creates a pool only of this and it issues bonds, that is known as credit card ABS. That is known as credit card ABS. Okay. If, I'm so sorry. Yeah. If it creates a pool only of 50 home loans, that is known as, that is known as residential mortgage backed security, RMBS. That is known as residential mortgage backed security. ठीक है? Now, a residential mortgage-backed security can be of two types. It can be SP has only issued pass-through security, or it has issued collateralized mortgage obligation. Okay? Now, but if the pool is of, if the pool is made up of, like, suppose the SP has bought everything. Suppose the SPE has bought everything. SPE has bought everything. Okay, then this pool is known as, CDO. Am I clear? Krusha, am I clear? If the SP has bought everything, then that is known as CDO. Am I clear? If it has only bought bonds, then it is known as collateralized bond obligation. If it has only bought leverage loans, then it is known as collateralized loan obligation. But if it has bought everything, thoda thoda, then it is known as a CDO. Am I clear? Now, okay. So the now what makes a CDO unique is basically in your CDO they have a collateral manager also. Like his main job is to keep on buying and selling loans. like like how we first studied कि bonds का value also keep on increasing decreasing. Yes, every year bonds का value also keep on increasing and decreasing. वैसे loans का value also keep on increasing and decreasing. Like if someone has become more risky, then the loan value, then the market value of the loan will go down. If the loan has got more, if the loan has got more safe, then the market value of loan will go up. Okay. So this collateral manager will keep on buying and selling loans and generating a return. It will keep on buying and selling loans and generating a return, and it will pass on the return to the bond investors. Okay. That is a CDO. Clear hai, Krusha? Try to maximize returns while meeting payment promises to investors. This active management is what CDO, which sets CDO apart. Okay. Now there are different types of CDOs. Cash flow CDOs, payments to investors come only from interest and principal. Most common type. If it is a market value CLO, then payments come from buying and selling assets based on a market value. Loan ka market value. And if it is a synthetic CLO, okay, so they do not actually own loans. They gain exposure via credit default swap. Basically, what do they do is like in the movie 2000, in the movie The Big Shot also, investor Michael Burry, what did he do is there was a CD, basically there was a the SPs were issuing CDO, okay, and they were raising capital through bonds. Now, what did Michael Burry do is he took exposure and credit default swap, saying this CDO is going to fail. So that is how he was not actually owning the loans, but he actually bought credit default swaps. Okay, if this fails, I can make a return on that. Am I clear, Krusha? That is known as a synthetic CLO. CLO clear है Krusha? What do you mean by a CLO? It is a package of everything. क्रेडिट कार्ड लोन्स भी है, क्या कहते हैं, what do you say, CDO is a package of everything. CDO is a package of everything. मॉर्गेज लोन्स भी है, क्रेडिट कार्ड लोन्स भी है, बॉन्ड्स भी है, लेवरेज लोन्स भी है. ओके. And CDOs can also be of different types. Okay. CDOs can also be of actually CLOs can also be of different. What do you mean by a CLO? Collateralized loan obligation. Okay. That is leverage loans. Only leverage loans. So your leverage loans are also divided into many types. First is cash flow CLO, market value CLO, and synthetic CLO. Okay. Any more questions, Krusha? This is all basic understanding. You have to read through it once. I hope you have got these notes. Any more questions, guys? Any more questions? ठीक है. So I guess guys, keep on practicing your questions. Okay. And if you have doubt about any question specific, okay, send it to me, and so that I can help you out in that. And best of luck, guys. Don't panic at all. Trust me. If you how many of you guys have solved the CFA Institute portal questions till now? How many of you guys have solved the entire institute question portal questions till now? Have you guys solved all the portal questions? Okay, if guys, you have to make sure that you have solved each and every question on the portal, and trust me, if you do that, there is more than 90% of the there's more than 90% chance that you will clear your level 1 very easily. Okay, don't panic at all. Best of luck, guys. And uh, it's okay, guy. Like you don't have to panic. It's just one exam. Okay? Any questions do you have for me? Okay, so I guess that brings an end to us our session for today. There are no more questions as I can see. Go ahead, guys. Take a small break and start solving your questions. Like I said, don't focus now on wasting time understanding theory. देखो अभी तक आपको जितना आ गया है, I'll give you a hack. Okay, I'll give you a hack. Whatever you guys know till now, whatever you guys know till now, you focus on that. You do not waste time in understanding things that which you have no idea about. Do not waste time there. Solve questions about concepts that you are very clear of. Keep on solving questions, and trust me, if you do that, there's a high chance that you will clear your level 1 easily. Okay, I'm going to repeat it again. Whatever concepts, whatever chapters, not only in fixed income but in any other subject, whatever concepts you feel I have no idea about, let me spend some time understanding that. Don't make that mistake. Okay, focus more on your strength rather than focusing on your weakness. Now this is a time where you have to go you have to be laser focused on what your strengths are. Okay, and I wish you all the best. Krusha, Samruddhi, Samiksha, and we have Abhirup. I wish you all the best, guys. Best of luck. If you guys have any question, you have my work number as well. Drop in a message. And if in case you guys are panicking, feel free to drop in a message. I will help you out to the best of my ability. Okay. Tanvi, sir, I was solving question, but now my re-exam is going wrong. Like, are you solving your questions again, Tanvi? Is that what you're saying? Tanvi, it might be due to stress. Trust me, it might be only due to your fear of giving the exam. It's okay. It's completely fine, Tanvi. It is absolutely normal to get a few questions wrong. However, one genuine piece of advice, okay, on your have you guys, I want an honest answer on this. Have you guys given your mock exams on your CFA portal website? Have you guys given your mock exams till now? I have 9 viewers right now. I want everyone to reply back. Have you guys given your mock exams on the CFA portal? कृषा नहीं किया अभी तक? क्यों नहीं किया कृषा? Tanisha not done? Samiksha not? Guys, क्यों नहीं किया अभी तक? When is are your exams in August or November? Tanvi, my first exam was 70%, and today, Tanvi, what you can do is, Tanvi, drop in a message to me na, so that I can understand where are you exactly facing a problem. Drop a message on my work number so that I can actually understand which subjects are you facing a problem in. Tanisha, Krusha, Samiksha, guys, why haven't you solved your mock exams till now? Krusha, cause we had 5 other mocks. 5 Shreyas was doing that, and also after LeapUp के mocks lost all confidence. So वो like सब पढ़ ले फिर. Ah, Krusha, I think the first priority has to be CFA portal. Okay. Tomorrow, first thing in the morning, give at least one mock exam. No matter how much you get, at least give one mock exam. Krusha. Let me know how does it go, Krusha, so that I can so that we can take the further steps then. Samiksha, you too. First thing in the morning, what do you guys do now is रात को थोड़ा सा ethics करो, ethics के questions. First thing, wake up in the morning at 9 o'clock. Sit at exactly 9 o'clock and solve your mock exam. At least give one paper at least. That is part 1 and part 2 both. Huh? Part 1 and part 2. ऐसा नहीं से part 1. Part 1 and part 2 both. There are 2 mock exams on your portal. That is of 4 parts. So you give at least one exam tomorrow. That is part 1 and part 2. Let me know how does it go so that we can take further steps then. Okay? And Tanvi, 70% and 55% are great. It's okay, Tanvi. 70% in the first exam and 55% in the second one. It is fine. You are currently, I would say you are much better than people who have not given the exam at all. Krusha, if you get less, so you get less. It's completely fine. It's okay. Don't have that fear. चलो ठीक है. I will leave it up. I will leave it right here, guys. For students who haven't solved their mock exam till now, first thing in the morning you have to do is solve at least one paper tomorrow, and let me know how it goes so that I can so that we can have a talk and we can see what can be done. Okay. Best of luck, guys. Enjoy it. Don't worry. Level 1 is very easy. You don't have to panic at all. Okay. See you everyone. Bye. Take care.